Greetings. Welcome back to another market commentary video for the month of November. I hope you all had a wonderful Thanksgiving. Today is Tuesday, December 3rd. So a little bit later than usual, but we still have some good graphs to show you, recapping the month of November as far as which asset classes did well. We've got an interesting look at 2016 versus 2024 in the election result, and then a couple other lighter-hearted graphs, one on Bitcoin, one on the US dollar. So let's get into the slides. I hope you all enjoy this. So despite all of the things people were worried about, both pre and post-election, the S&P 500 is off to one of the best years that we've seen in recent memory. And I always say this, but the market doesn't really care what people are talking about. The stuff that's in headlines, the stuff that is around the water cooler, markets are very much forward-looking. And true risk, what often gets investors is everything that you don't think about. So let's get into the slides. So this is November 1st to the last trading day in November, which I believe was the 29th. So a look at various asset classes. Let's lead with Bitcoin. It's been an absolute juggernaut. A lot of folks have asked me about the Trump trade. The Trump trade was and is Bitcoin. So the president-elect has been the most pro-digital asset, pro-Bitcoin president in recent memory. I've said this before on the podcast. Never in my life did I think I would see a presidential candidate endorse Bitcoin and want to become a global hub for digital assets. And I think you're seeing that show up in the price of Bitcoin. Congratulations to those that own Bitcoin or own digital assets. It's certainly been a lucrative year for you. And then moving on down, small cap value had a really good run post-election. You can see the kind of the spike here, and it continues to ascend up about 10% this month. Of course, the S&P 500, one of the best months or the best month of the year in November. Real estate has bounced back. Tax-exempt bonds, these are 7 to 10-year bonds, performed well. Foreign stocks are up modestly. And then emerging markets and gold took it on the chin a little bit. Stronger dollar, a lot of tariff talk as it relates to emerging markets. Of course, China is a big chunk of the emerging market index, and the sensitivity of gold is very much tied to the US dollar. So mental shortcut, the stronger the dollar, the less attractive gold might be in that type of environment. But I'll get to something a little bit later that shows investors why you shouldn't overreact to some of these moves. What happens post-election or post-market event is the market is trying to dissect and anticipate what the incoming president's policies are going to be. And oftentimes markets overshoot, and then time passes, markets and people move on from the election, and the next market headline dominates. So that's probably what we're going to see again, and there's evidence to support that in this next slide. So this might be a little bit small. I encourage you to pause and blow this up if you can't see it. So what we've tried to capture is the month after the election in 2016, which asset classes, which sectors performed best, and then further, 1 year after that election in 2016, what asset classes and what sectors performed best. And an interesting theme appears. Now, I want to have a caveat here. I'm not saying this is going to hold in 2024. There's been some loose correlation between what happened in 2016 and what's happening in 2024. But different environments, different economies, different Fed policy, different interest rates and inflation, you get the point. So the first month after the election in 2016, you can see the top 10 performing sectors and asset classes. So going on down the list, I'm not going to read all of them. Let's just look at the top 5. Small cap value, the financial sector, think big banks, small cap growth, energy, mid cap value, industrials, materials. Okay. An interesting development happens. These were the best performing 1 month after the election in 2016. Going out a year after the election in 2016, many of these top performing asset classes and sectors became some of the worst performing asset classes and sectors. So the key takeaway is don't overreact to what the market is doing now. It often overshoots. Again, over time, things will normalize, policy will become more clear, but most importantly, the market's going to move on. I always scratch my head when I get these, Trump's going to do this or Harris is going to do that. The U.S. economy is worth $30 trillion. And The global economy is worth more than that, and it's a complex system. So things like inflation and interest rates, consumer behavior, debt levels, currency movements, corporate earnings, corporate profits, forward guidance from companies. These things matter much, much more than who's sitting in the White House. So this is probably the most thought-provoking chart. The key takeaway is don't overreact, because what's doing well today, that could flip, and the best performers might become some of the worst performers. And conversely, some of the worst performers might become one of the best performers. So one thing that's really interesting about this, certainly a lot of tariff talk out there. Take a look at what happened in 2016. The same kind of narrative sprang up, a lot of tariff talk. Well, the emerging market index is like 40% China. It was one of the worst performers post-election in 2016. Look what happened a year later. Emerging markets were one of the best performers. So a lot of this tariff talk is simply negotiating tactics, getting companies to reshore, getting countries to engage in more favorable trade deals, tightening up supply chains. So, I wouldn't necessarily believe everything that you see on the news. Again, this tariff talk is nothing new, happened in 2016, and lo and behold, emerging markets, which is 40% China, one of the best performers during President Trump's first year in office back in 2016. Okay. After today, we're not going to talk about politics anymore, but given I've been talking about politics for 11 plus months, we're going to put a bow on it with this. So this is the average Dow Jones Industrial Average performance during sessions of Congress from 1901 to 2024. There's lots of narratives out there. A red sweep, a blue wave is bad for markets. When you zoom out, it's actually not all that bad, and there's actually some silver linings here. So, of course, we got a red sweep, President, Senate, and House. That's happened 14 times over the past 123 years. The average Dow Jones percentage change during a triple R, as I am going to call it, is about 18% for an annualized gain of roughly 8%, with the Dow Jones up almost 79% of the time. When you compare that of all combinations from all blue wave to all red wave and everything in between, 62 different periods, Dow Jones has gone up 15.5%, average annualized gain 6.5% of the time positive, 71%. There's also a narrative that gridlock is good for equity markets, right? Gridlock would be like a Democratic president, Senate Republican, House Republican. That's a split Congress versus the president. That's actually not the case looking back at 123 years. When one party dominates, either triple D or triple R, that's happened 35 times. The Dow Jones is up almost 18%. Annualized return shade under 8, 71% of the time positive. All combinations of gridlock, 27 instances, 12.5%, 5% annualized, and about the same percentage of the time positive. So there's a lot of narratives out there. We're big on empirical evidence. And again, I think who's sitting in the White House is less important than people think, but nonetheless, it's a topic of conversation. When you zoom out and look at the actual numbers, gridlock, one party in charge, it's all actually pretty good. We're blessed to live in a country where entrepreneurship, the rule of law, we have some of the best companies on planet Earth. That really drives markets and drives the economy. Okay, this is kind of tongue-in-cheek, but I have to give a shout out to Bitcoin. It's been an absolute juggernaut, not only in October and November, but in 2024 thus far. So I know this is a little blurry, but I think you can get the picture. A couple weeks ago, I wrote a blog about let's not look at who's in office and how that impacts markets. Let's look at themes over the next 5 to 7 years that are not going to change and highlight several asset classes that could benefit from some of those themes. And the themes were inflation, loss of purchasing power of the US dollar, and debt, fiscal recklessness, outsized government debt. And Bitcoin was one of these themes. And I think this is a really great way to understand Bitcoin. I understand it's a polarizing asset class. Some people get it, some people don't get it. It's very confusing. This is one of the main theses behind Bitcoin. So what you see here is back in 2002 going to 2021, we're measuring the purchasing power of the US dollar. So back in 2002, a 20 might have gotten you a cart of groceries. As we move through time, the amount of groceries that you could buy with $20 steadily goes down. And in 2021, you could argue $20 barely buys you a bottle of orange juice. Looking at Bitcoin, back in 2012, it barely bought anything. The price of Bitcoin was basically nothing. But over time, Bitcoin has certainly grown in value. And through time, you can see the visual here changes where you can buy a very nice Mercedes AMG SUV with 1 Bitcoin. So again, the thesis behind Bitcoin is it's a store of value. It's going to maintain your purchasing power. You can't print more of it. It's a fixed supply that a government, a bureaucrat can't mess with. I'm not saying Bitcoin is for everybody. Again, it's a polarizing asset class. It's for a certain makeup of investor. It's a volatile asset class. You need to be very sensitive of position sizing of Bitcoin. But when you look at what the long-term Bitcoin maximists have said, their long-term thesis of greater government debt, bureaucratic control, control of banks, a decentralized currency that no one can mess with, a lot of that has played out in real time, almost exactly consistent with their thesis. So this is a fun little visual. I thank you for tuning in. If you have any feedback for us, shoot us a comment on YouTube, shoot us a note at insight@pureportfolios.com. I'll see you next month for a longer, more thorough 2024 year in review. Take care. I'll see you next time.